All right, we're on learning objective 3.3, and we are going to explain the purpose and journalize and post some actual adjusting entries for deferrals. Okay, so here we have the unadjusted trial balance. That's the same trial balance we actually did in chapters 1 and 2. Okay. We just called it a trial balance. We didn't actually call it an unadjusted, but now we need to call it unadjusted because we're going to do another trial balance that is adjusted. Okay. So unadjusted, it just has all of the assets, liabilities, equity, revenues, and expenses. Every account, every single one in the trial balance. Remember, the trial balance is not a financial statement. Okay. So if you get a text question that says, is the trial balance financial statement? No, it is not. This is more of an internal document. And so if you can kind of see if they do these correctly, you can see there's some line, kind of imaginary lines. Let me, okay, so we can see right here between, stop. There we go. So we have cash, accounts receivable, supplies, prepaid rent, land, building, and furniture. Notice every one of those has a normal debit balance because those are all your assets. Okay. Now we have our liabilities, accounts payable, utilities payable, and earned revenue, and notes payable. Those are all liability accounts. And then we have our owner's equity accounts. Then we have our revenue. And then we have all of our expenses. Okay. This has to be done in order: assets, liabilities, owner's equity, revenues, and expenses. Those are your categories, and and really, even as far out as we go in counting, those are going to be five categories. Okay. Everything else will just pretty much fall up underneath those categories. Okay. So, adjusting entries. I always try to tell students there are some things not to guess when it comes to adjusting entries. Okay. Almost never is cash going to be involved. Okay. I say almost pretty much for this chapter. Um, Almost never cash. There is a one or two transactions in a chapter like way on down the line, but you're taking this test for over chapters 3. Don't guess cash. Cash is not going to be an answer. Okay. These are all done at the end of the period. If that end of period is 12/31, at the end of the period, if it's the end of the month, end of the quarter, they'll always be done that last date. So if this is a year end, a calendar year end, every one of the adjusting entries and closing entries will all be dated 12/31, the last day of the period. Okay. They will involve one income statement account and one balance sheet account. But remember, never cash, always at the end of the period. Okay. Have two categories: deferrals and accruals. We have a total of four categories. I really like that they used to do like five categories, and really two of them would go into the same category. I just don't know why they would do a different category, but I do like this. This is good. The first one we're going to do are the deferrals. These are deferred expenses and then deferred revenues. Okay. We'll do the accruals in the next video. Okay. So let's talk about deferred expenses. These are things that we have already paid the cash for. We just are not going to have an expense until later. Okay. So examples: prepaid rent and office supplies, prepaid insurance. And this is the biggest category. A lot of times, once we get through this category, the other three are not that difficult. But this is a big category because there are a lot of expenses that we have to pay up front. Then we actually can put an expense on our financial statements. We did a prepaid insurance up there in the previous video. All right, so that prepaid insurance example that we did in the previous video is just it. This is the category it fits into. Okay, so it could be prepaid rent or insurance. We're treated exactly the same. Office supplies, remember how I said, if I'm in the classroom teaching and I have that podium up there at the front, pretend like that's my supply closet. And that's how much supplies I have in there. That's an asset because it hasn't been used yet. All of those things I've said in previous videos, one, two, and this one, is because we're on accrual-based accounting. Okay. And then depreciation is just completely different than the other two. So we'll get started. So on December 1st, they prepaid rent for $1,000. December 1st, this is the original entry. Okay. I don't want you to get confused because I did say the adjusting entries did not involve cash. This is not the adjusting entry. This is the original entry. Okay. And we'll probably be making this entry from till December the 31st. Okay. So these are two assets. We traded one asset for another asset, increased the prepaid rent asset, decreased cash. Okay. So here is what they did. December 1, $3,000 got debited to the prepaid rent. And as of December 31st, prepaid rent should be decreased by the amount that it was used up. Okay. So that was over 3 years. So $3,000, if we divided it by three, that's $1,000 per year. But I believe they're wanting us to do this for per month. So let's see if they did the calculation for us. So let me right back up here. Oh, it was for 3 months. I'm so sorry. I got that wrong. I was like, no, looking at the solution. I was like, well, maybe I did it wrong. I did not. 3 years, I'm sorry, 3 months. So it is $1,000 per month. Okay. End of the period is December 31. So from December 1 to December 31, we've used a third of that, $1,000. And that's where they get the 1/3 right here. Okay. This is the adjusting entry. Okay. I had a student, an accounting student, ask me a long time ago, like, what triggers some of these adjusting entries? In this one, the passage of time. Time has passed 1 month, and so I have to make sure that my asset, my prepaid rent, my asset is correct, and my rent expense is also correct. Okay, so this is the adjusting entry. This is your income statement account. This is your balance sheet account. Remember, never cash and always at the end of the period is when it will be dated. Okay, so you can kind of see in T account what's going on here. That prepaid rent, we started it with 3,000. We're adjusting 1,000 out to give it a balance of 2,000. That makes sense because this prepaid rent is good for January and February. So we have an asset of $2,000, which is exactly what it's worth. Okay, because we have 2 more months. After each one of those months, we'll make this exact same entry, adjusting entry, to make sure that $1,000 gets put on each month. Okay. So that's prepaid rent. Now let's look at office supplies. Anytime you get an office supply question, go ahead and start you a T account so you can figure out what is going on. Okay. Before I start adding numbers into the T account, I want to do this T account with words to kind of help you know where numbers are coming from. Okay. Office supplies is an asset. So it will probably come over from the previous period. There will be a balance on the debit side. This one really it can't really move to a credit. If it did, you did something wrong. You can only use up what supplies you have. You can't move that over to a credit balance. So there's probably, if you see office supplies with a credit balance, there is probably something wrong. Okay. So you have your beginning balance, ending balance. What's going to be on the debit supplies is new purchases. New purchases. What leaves office supplies is the expense. Okay. Sometimes it helps just to put the words into these T accounts. Okay. So I'm going to leave that there. I'm not going to erase that. So every time I see a supply problem, I just go ahead and draw myself a T account because sometimes it's hard to see the tree for the forest and I can see it better in the T account. Okay. So it tells us that Smart Touch Learning purchased $500 of supplies on account. The journal entry to make that $500, we did, we debited office supplies for 500. This is the original entry. And we're crediting accounts payable for that 500. Okay. So here's our new purchases. They didn't tell us anything about a beginning balance because this was a new company. Remember, Smart Touch was a brand new business, and we're taking this brand new business through the whole accounting process. Okay. So you have to be really careful when you get a supplies problem because they love to trick you on it. Even when I took the CPA exam a few years ago, they still pulled this trick out of their back pocket. And I don't want you to get confused by the trick. Okay. So here they tell us at December 31, $100 of supplies remain on hand. What does that mean? That means they're telling me what is left in that supply closet. Okay. You picture me standing at the podium there in the classroom, and I had a supply closet. We put $500 worth of supplies in there when we bought them on November 3rd, but now we've went in there on December 31st and we've counted, and there's $100 left. $400 left the building somehow or another. Okay, whether it was stolen or whether it was used. So we can, I don't really like all this equation stuff. If you do, that's fine. I like to see it in a T account. To get from $500 debit to $100 debit, $400 of supplies were used up. Okay, that's your supplies expense right there. If you write this T account for office supplies, you know you're going to credit office supplies for $400, which we're going to come down here and we're crediting the office supplies. This is the balance sheet account. And then we're going to debit supplies expense for that 400. Okay. They drew some T accounts out. I liked mine with the words in it. If you want to pause the video and grab a picture of that, I'm totally fine with that. Okay. Or if you're taking notes, you can also pause the video and take some notes. Okay. This one, they can trick you. Okay. The other thing they could have said that $100 of supplies were used. If they did that, they're telling you what the supplies expense is. Okay. But if they say something like remain on hand, and they could do this for prepaid insurance or prepaid rent, they could say unexpired rent, unexpired insurance. Those are ending balances, and they're wanting you to back into what was used. Okay. So this will get easier the more practice you get. So there's the journal entry for the adjusting entry. That journal entry that we made right here, that was the original entry. That was not the adjusting entry. The adjusting entry is right here. You can see both T accounts. Think about if you did not make this entry. Okay, let's think about we didn't make that entry. We would not have this supplies expense. We'd have $500 on our balance sheet. We're telling our users that we have $500 worth of supplies. We don't really have $500 worth of supplies. We only have 100. So that 400 would fail to get over to the income statement. Our expenses would be understated. Our assets would be overstated. So we don't get good information if we don't do these adjusting entries. Okay. All right. One more in this category is depreciation. Okay. These are all of that property, plant, and equipment that we talked about. Okay, like land, buildings, equipment. Now, I'm going to throw land out there. Land doesn't get depreciated. I've mentioned that before. Land never gets depreciated because, God forbid, Watkins Building was blown away by a tornado. The land is still good. There is nothing wrong with the land. We can build another building on there. So if you own a building and a land together, you're still going to have to separate them on your balance sheet because the land's not going to get depreciated. Okay. Buildings will get depreciated, equipment, furniture. Okay. So depreciation expense is what we are looking at here. Okay. So there's a couple of things that go into the calculation of depreciation expense, and they are the cost of the asset. That's what we paid for it. The residual value. Okay, residual value can sometimes be called salvage value. Okay, it can be called salvage value. What that means is just how much is it going to be worth when we're done using this asset. Okay, when we're done using this asset, however long, a building is going to be a lot longer, 20, 30, 40 years. Equipment, maybe 5 to 7, maybe 10. Okay, it depends on what it is. Equipment, cars. Have you ever, probably none of y'all, but I know at one point, me and my husband had a car that was not worth anything. We had to drive it in like first gear all the way to the salvage yard to sell it to the salvage people. We were just selling it for scrap metal at that point. Okay. It was worth nothing, but it was worth a few $100s of scrap metal. That could be the residual value. Okay. That could be the residual value. All right. You also have estimated life. Okay. We're not going to be doing a lot of this calculation here. I just kind of want you to know where the numbers are coming from. Estimated life, how long is it going to last us? If it's a building, 20, 30 years. Equipment, 5, 7, 10 years. Okay. We have to have all of those things to calculate depreciation. Okay. So those are our three variables. The only one that's constant that we can assign a dollar value to, and we know that's exactly it, is cost, because we know what we paid for it. We don't really know that the residual value or salvage value is actually going to be however much we estimate it. We don't know that it's really going to last us however long we estimate it. So these two items are estimates. Okay. There is a lot of things on financial statements that are estimates. Okay. So on December the 2nd, Smart Touch Learning received contribution of furniture with a market value of 18,000 from Sheena Bright in exchange for capital. So a lot of times you'll see the owner put cash in, which she did that at the very beginning of this business. She did put some cash in. Now she's going to put some furniture into the business. She is getting capital because that's what she's put into the business. Okay. This period. Okay. The furniture is going to go into an asset account. Now, remember, furniture, property, plant, and equipment, all those things are going to last us a lot longer. Okay. We're going to start getting down to a classified balance sheet as we go through these chapters, and then you'll kind of understand things that are short term and things that are long term. Okay. So, these problems are probably not going to, here in this chapter, aren't going to make you calculate the depreciation. They may tell you exactly what it is. They didn't make us calculate this, but you can kind of see it had a cost of $18,000 and it had a salvage value or residual value of 0. And then the estimated life was 5 years. Okay. How you calculate that, you would take, let me write it, cost minus salvage value divided by, I'm just going to do years for right now. Okay. There was no salvage value. They said it was going to be worth nothing at the end of its life. So we end up with 18,000 divided by 5. Okay. Then that gives us a per year amount, which is 3,600. And then they divided that by 12 years to get a per month because they bought this December 2nd. So we're only going to have depreciation for 1 month. Okay. We're not going to have depreciation for a whole year, that 3,600, because we only had it for 1 month. Okay. The journal entry to make this depreciation, this one's going to be very different. I told you it's completely different than those other two, but it's okay. We're going to debit depreciation expense, and we may have other things we're depreciating. So we put a little hyphen here and say, hey, this is for the furniture, because we might be depreciating the building as well. Okay. So we're going to debit the expense, credit this new account called accumulated depreciation. What is accumulated depreciation? So they gave me the T account for furniture and for accumulated depreciation for the furniture. Okay. These two accounts, this is cheesy, but you're probably going to remember it this way. These two accounts are married till death do them part. These two accounts cannot get a divorce. Okay. As long as you have the furniture, you will always have the accumulated depreciation. Okay. So we credit this account. What is accumulated depreciation? It is a contra asset. Okay. I'm going to come over here and draw the T accounts for those out just because I want you to see a few more things. Okay. I'm sorry. My handwriting gets bad when I'm trying to write fast. Okay. Remember, we have debits on the left, credits on the right still. Okay. These are assets. It's going to be in the asset section, but both of these accounts are going to be together. Okay. So the furniture has a normal debit balance. I told you accumulated depreciation is a contra asset. What does contra mean? Just vocabulary. Contra means opposite, right? Opposite of the asset. Okay. So the normal balance for accumulated depreciation is going to be a credit. So what does that mean? To increase accumulated depreciation, we will credit that account. Okay. So we ended up with, we have 18,000 in the furniture and 300 in the accumulated depreciation. So we're going to talk about this thing called book value. Okay, what is book value? Here's where I lose some students because they think book value. Maybe your parents or maybe you traded in a car, and when you went there, they called it book value. That's not what we're talking about here. When you do that, when you trade a car in for a car, that's fair value. I don't know why they call it book value, but that's not the same as our book value. It's kind of like the debits and the credits. Remember, I told you other professions have taken our terms and they've used them for different things. Book value in the accounting classroom just means cost minus accumulated depreciation. So this account minus that account. So our cost was 18,000 and then we depreciated at $300. So that leaves us with what, 17,700. Okay, that's my book value. A lot of students want to say, oh, that's what it's worth. That is not correct. Okay, because remember, I told you that two of these things right here, just based on estimates, we don't really know if it's really going to be worth zero. It might end up being worth more than zero. It might end up lasting us longer than, what was it, 5 years? It may end up lasting us longer than 5 years or less time. Okay. These two things are estimates. Okay. So book value is just what you're carrying on your books as. Okay. Book value is not equal to fair value. Okay. Not equal to fair value. Okay. If those two numbers equal, it is purely a coincidence. Okay. They are not related to each other. When you go trade a car in and they talk about book value, they are really talking about fair value. Okay. So that's the hardest one in this category. Okay. I usually take a break, but I want to finish up this learning objective. Everything I just wrote out is on this slide right here. So I'm not going to repeat everything I did. But remember, these two accounts married. They can't get a divorce. Okay. All right. And there's the book value. They did more of it than I had planned. All right. Let's do one last example. They do have depreciation for the building. And look here, they just told you what it is. That most of these problems in this chapter, they're not going to make you calculate it. They're going to tell you, they may say depreciation for the year is this amount, and you might have to divide it by the monthly. But most of the time, we're just trying to get the journal entry correct here. We got a whole chapter 10 that will deal with depreciation and calculations, and it's got a lot of math in it. It's our last chapter. A lot of students love that one because they've made it that far in accounting class. Okay. So here, they just told us what it is. We're going to debit the depreciation expense for the building, credit accumulated depreciation. And I love that they gave us this right here. Notice that land is not being depreciated. Land will not have an accumulated depreciation with it unless, remember I said in the previous chapters that there has been some cases that went to the Supreme Court where they actually got away with depreciating land. But for this textbook, you're probably never going to see that. Okay. It does happen every now and then, but most of the things you're going to see, land's not going to have that accumulated depreciation because we don't depreciate it. Okay. So now you can kind of see, look, we depreciated that building some. Here's the book value of the building. Here's the book value of the furniture. Okay. Does not mean that's what it's worth. Okay. Remember, those other numbers were estimates that were not based on anything when it comes to fair market value. Okay. All right. Let's talk about deferred revenue. Okay. This is when a company receives the cash and they don't deliver the work or the product until after the fact. This is that unearned revenue. Okay. So we're almost done with this learning objective. So hang on with me for a few more minutes. All right. December 21, a law firm engages Smart Touch Learning to provide e-learning services for the next 30 days, paying $600 in advance. I think this might be the exact entry we did way up there. Maybe or maybe not. All right. So we're debiting cash because we got the cash. Remember, I said I got the cash. Somebody gives me $100 to do that tax return. I'm going to put that cash in my pocket. I'm going to buy groceries. I'm going to do other things with it. Okay. But I owe the services of $600 to that whoever that customer is. I owe them. I don't necessarily owe them $600. I owe them the services of $600. Okay. So unearned revenue is a liability. Okay. All right. They tell us that during the last 10 days of the month, Smart Touch Learning will earn a third of the revenue. Okay. So let's come over here and I'm going to draw that T account out for unearned revenue. We credited that for 600 because we owe that. We debited cash because we got the cash for it. Okay. But we haven't earned all of that. So they told us one third, 600 multiplied times one third will give us 200. We're doing some real easy math here. Okay. And so we're going to make the journal entry to debit the unearned revenue. This is our balance sheet account because it's a liability. And then the service revenue is our income statement account. Okay. This journal entry right here is not the adjusting entry. Okay. It's the original entry. And sometimes it really helps to know what the original entry is to make the adjusting entry. Okay. So we come down there, we're going to credit that account, I'm sorry, debit that account, and we will end up with a balance of $400, which fits, right? Because we still owe that customer $400 or two-thirds of that. So that liability will be on our financial statements as we close out the books for the year end. Okay. And that is all. We will pick up on the next learning objective 3.4.